Friends, this is a component in one of the indicator, this black line. Now for time being, just assume if the price opens below this black line, it will be bearish. If the price opens above this level and sustains above that level means it is bullish. Just check. Here the price opened below the black line, right? It as of now it stayed bearish, right? See here the price opened below the black line, but it failed to trade above that level and it went into sideways mode, right? The same logic here as well, right? At the end of the day, it moved a little bit, but that's fine. See here in this case, on this particular day, this is Nifty 50-minute chart, okay? So price opened below this line. Again, Nifty took exactly resistance at this level and it came down, right? See here, this is very interesting here. For the first time, it price opened above that black line. It went below, it went above, which means it is volatile, right? If you look at the market at that particular time, it went into volatile, right? Sideways, complete sideways. See here the price, this is the only exception, okay? So in this particular day, price opened below this black line, stayed above this black line, okay? This is an exception compared to these many days, right? Similarly, see here price opened little below this black line and took resistance and it stayed down, right? See here price opened above this black line, stayed above, completely stayed above that particular line, right? Here there is a huge gap, it stayed above, right? If I can go on and on and on, right? See here price exactly took support at this black line, right? Okay. So we will know more about this indicator. Most traders stare at charts all day looking for some magic signals. But what if I told you the market already gives you those signals before the market even opens? They are called pivot points. And once you understand them, you will stop chasing candles and start predicting them. In this video, I will explain how 2% of smart traders use these lines to enter into the trade with confidence and exit with profits. No fancy indicators, no complicated setup. Just 3 lines that work again and again, again and again. Friends, my new book, Options Trading Made Simple, will be released very soon by India's leading publisher, Jaico Publication. So keep an eye out for this book whenever you visit the nearest bookstore or browse Amazon. So without wasting much time, let's dive into the topic of pivot points. Friends, without wasting any time, straight away I will come to the point. Why we need to use pivot points? That is the most important question, right? For that, you need to understand one thing, the importance of close on any trading day. For example, I will start from here, okay? So just observe the close here. Okay, I will observe the close here. The close is very near to the day's high, right? Whenever the close is near to the day high, there is a higher probability of continuation on the next day also. See here, the next day also the close is very near to the day high, right? So until it goes to the any other important resistance level or any other important price level, price keeps on displaying the same behavior. See here, the price also closed very near to the day high, right? But here this is an important level because price opened with a gap down. So usually if you remember, gap acts as a resistance, okay? So that's why here it went into sideways mode for a couple of days. But after this, see here, after this consolidation indicates short squeeze kind of thing, okay? Shorts are getting built but price is not going down. So after this breakout, once again, the important price level is somewhere here. Till that point, there is no important price level, right? See here, the price closed near to the day high. Next day, again, it went upside, right? So price closed near to the day high. Again, next day, it went upside, right? Same here until it reached an important price level, right? So what I'm trying to say is very, very simple, friends. A close on any trading day is very, very important. It will place a very, very, very crucial role on next day trading. unless there is another important swing high or swing low from the daily chart, okay, or weekly chart. Those kind of round numbers or those kind of swing lows, swing highs matters a lot. If there are no such swing lows or swing highs, which means if the close is near to the day high, there is a high possibility on the next day also price going to upside. If the close is near to the day's low, then there is a high possibility of price going on the downside. I hope now you got the clarity that why this close is very important. Now we will come back to the pivot point. Uh, Before coming to the pivot point, I want to explain one more thing. You might be knowing this already, the importance of previous day high and previous day low. See, for example, this is Nifty 50-minute chart on one trading day. See, this is the day high, right? This is day low. For example, let's say uh, today you are trading here. This is the previous day information. So, which means this is previous day high, this is previous day low. Do you have any idea what is PDH? So PDS stands for this is the price level where the last buyer was present, right? Which means above this price level, there was no buying order. Or at this price level, strong sellers entered into the market and their action pushed the price downside, right? So whether it pushed the price till here, that's a different story. But this is the price level where the strong seller is present, and this is the price level where the last buyer was present, right? Similarly, if you consider this is previous day low, right? So previous day low is the price level where the last seller present, right? Below this level, there were no sellers, right? Or in other words, so this is the price level where strong buyers are present, right? So if the market if there is no change in the market sentiment overnight, so the same level will act as resistance, and the same level will act as a support on the next trading also, right? So which means there are three important level. Close is very important, as I said earlier. Previous day high is very important. Previous day low is important whenever you plan to take intraday trades on the next day, right? Now we'll come back to the pivot point. So if you look at the pivot point formula, it is considers three things. High, it covers a day high, very, very important. When I say day high, these things will be calculated from the previous day data. Okay, so it will take the previous day high, this is previous day low, and this is previous day close. So it will add up high plus low plus close divided by 3. We will get PP. So the black line I have explained at the introduction of the video, it is nothing but a PP in pivot point. Pivot point consists of many other lines as well, like R1, R2, S1, S2, etc., which I'm going to cover in the next few slides. But the black line I explained in the introduction, it is only the pure pivot point. Now, one simple logic. Whenever the price opens above pivot point and sustains above pivot point, so we can only expect sideways to upside move on that particular day. Again, anything can happen in the live market, because if there is a natural calamity like an earthquake, or if another country attacks another country, invades another country, if war starts, the price will fall. That's a different story. Barring those situations, if the price opens and sustains above PP, means there is a high possibility of price going on the upside. Similarly, if the price opens below PP and if the price sustains below PP, means we can only expect sideways to downside move on that particular day. I hope this is clear. This is the importance of PP, pivot point. This is very, very important. Okay. Now, R1 and S1. So I suggest to use PP, R1 and S1, maximum R2, S2. These 5 are enough. For me, PP, R1 and S1 is enough. But if you don't want to leave everything, then you can also include R2 and S2. And this is the formula for R1 and S1, 2 into PP minus low, S1 is 2 into PP minus high. It's very, very simple. So you will get the first resistance and the second resistance. So in platform, you can also get R2, R3, R4, R5. There are so many levels like that. But I suggest not to use all those things because it brings unnecessary confusion and headache. I suggest to use only PP, R1 and S1 is enough, but you can also use R2 and S2, but not more than that. These things are sufficient enough because in trading, simplicity is very, very important. If you get confusion in the live market, any kind of confusion costs you money in the live market. That's why I want to keep things very, very simple. Okay. Now, as I said, you can use R2 and S2. I don't want to get into the formula for R2 and S2 because personally, I'm not a formula guy. So it's fine. Now, whenever you plot this pivot point, it looks like this. Sometimes, most of the cases, what happens is it plots the line, it will display the values in the previous day thing. So whenever you are studying pivot point, you might get confused. So whether these numbers belongs to this day or this day, okay? So you will get confused, but there is a simple option to remove those numbers. I will show you it on the chart, for example. So if you go here, I've already plotted. If you don't know how to plot it, I will show you. See, if you go to indicators, if you type pivot point, so use this. There are many different types of pivot points indicator there, like pivot point standard, pivot point Fibonacci. There are so many things. I would suggest to use pivot point standard. Okay. And also, as I remember, in almost all the pivot points indicators, PP calculation is same. Only the R1 S1 calculation, R1 R2 S1 S2 calculation might change, but PP calculation remains same in most of the pivot point indicators. Now I'm going to plot this. So whenever you plot this, it looks like this. It brings a lot of confusion, right? But don't worry, there is a simple way to get rid of this. Click on this, go to this, and first thing I do is I remove S3, S4, S5. I remove R3, R4, R5. So I also remove S2 and R2, but time being I keep this. Now, whenever you look at this, all the line color looks the same, right? So I want to differentiate P. So P, I will mark it as block. So in this way, you will get some clarity, right? What is P and what are R1 and S1. Now I'll increase the line width to 2 so that it appears properly. Okay, this is the first setting you have to do. Now, as I said earlier, these numbers are 2, 2, 2, 3, 4. Actually, these numbers belongs to this particular day, but it is appearing, instead of appearing here, it is appearing on the previous day overlapping, right? It might bring some confusion. So it is better if you remove these numbers. Okay, so just click on this, it will remove the number. Okay, you can also remove this. There is an option here. You can click on this. If you want, you can also remove it from here. If you select labels, everything will be cleared, right? So you can retain the lines. Lines we needed, retain the lines. So this is very, very simple. So black line is PP, above is R1, R2, this is S1, S2. So in this case, there is no option to change S1. For example, in some charting platform provide, you can use this as a green or red. You can use the another colors like this. But in this case, it is, I think we can also do it here. For example, S1, S1 ke liye you can use, for example, you can use red. Okay. S2 also I use red. Now for R1, you can use green. And for R2 also, you can use green. This green. Okay, you can use like this. So but personally I don't use colors like this because whenever you use red or green, it gives some confusion about, our mind assumes like, this is a support, this is a resistance. It assumes like that, right? So I don't want to bring that confusion into my mind, so I will retain the same color for S1, R1, R2. So in my opinion, it's very simple. See, this is PP, this is R1, R2, S1, S2. And whenever you can check, if not Nifty, you can go to Bank Nifty also. See, for example, if I go to Bank Nifty also, Okay, I will come here. See, whenever the price, see here, price opened below, took resistance at PP, it came down, right? See, price opened above PP, stayed above PP. Here is exception, as I said to the Nifty. Here, it took resistance and came down from PP, stayed above PP. Here, it opened with a PP, I mean, opened above PP, stayed above PP, right? See here, the PP acts as a support. Here, it stayed above PP, exactly took resistance at R2. Okay, so you can check any instrument. See here it acted as a support. Uh, See, it works almost similar in most of the cases. So this is how you can remove these numbers to avoid any confusion. Uh, because this number overlaps with previous day data. This is one thing. And the next thing is whenever the market completes, let's say today market is going on, for example, it closes like this. So this is, you will get a line like this. So for the next day, it will not display these PP lines until the market opens. Some charting platforms gives these numbers in advance, but I've noticed in TradingView it will not these levels until the market opens. This indicator, this particular indicator, calculate the levels and plot this numbers only when the market starts. Okay, so one simple option is you can use any chart GPT. If you give the previous day high, low and close, chart GPT will give the levels, PP, R1, R2, S1 and S2. You can mark those levels before the market open itself, or you can use the numbers once the market opens. That's also possible. Okay, I hope that's clear. Now to go forward, we'll go a little bit forward. I don't want to waste more time. I hope you got the number, right? You can get rid of these numbers so that you can get only the lines and it gives more clarity in your mind. Now, these values remains the same, which means, for example, PP, okay? It is calculated from previous day high, previous day low and previous day close. They add three numbers and divided by 3, right? Now, it will appear like this. For example, today market open, this is the PP and this is the R1, this is the R2, this is S1 and this is S2. Market is going on. So whether you use 5-minute chart or whether you use 10-minute chart or whether you use 50-minute chart or whether you use 30-minute chart, these levels remains the same. I'll repeat once again, friends. Irrespective of the time frame you use, these levels remains the same, which means these levels are helpful for all type of intraday traders, right? There are some scalpers. So even intraday traders, some people use 50-minute chart, some people use 30-minute chart, 20-minute chart, 12-minute chart. There are so many time frame people will use, right? So it is helpful for all type of intraday traders because the value remains the same. But you need to observe the price action at these levels to initiate the trades or to exit the trades or to carry forward the trade, which I'm going to cover in next few slides. Okay, that point is very, very important. But what I'm trying to say with this slide is these values PP, R1, R2, S1, S2 remains the same irrespective of your time frame. Even if you change 5-minute, 10-minute, it will remains the same. Okay. Next, how to use PP, R1 and S1. Okay, this is the main important point. Now, let's assume I will write it in a different color so that you will understand it in a better way. Now, let's assume this is PP. Okay, so this is PP. For S1, R1 and R2, I will use a different color so that you will get a better clarity. For example, this is R1 and this is R2. Ignore this. I'm writing this through the mouse, so it's not. It's looking very ugly. So please don't take it in a negative way. Now we'll come back to the candle. For example, let's say price opened above this. For example, let's say this is a green color candle, and it appeared like this, which means this is open, this is close or days high, both are same actually, and this is the low. So now let's assume the previous day trend is positive and price opened above the PP, and it displayed, it tested the PP. Sellers tried to push the price downside, but it closed above the PP, right? As I said earlier, if the price opens and stays above PP means, so there is a high possibility of price going on the upside. That's very simple. So now whenever you get this formation and Nifty 50-minute chart, I suggest 50-minute chart is best time frame for intraday trading, because if you use 5-minute chart, there is a high possibility of getting noise also, sometimes even in 10-minute charts. But at the same time, if you use 30-minute chart, there is a possibility of missing the some of the good trade opportunities. So that's why I suggest 50-minute chart is fine. So whenever you get this formation, assume this is a bullish candle, this is green color. Whenever you get this formation at PP, so what you can do is you can take a long trade little above this candle, keeping a stop loss below this level. Okay, so here the two confirmation, PP also acts as a support, right? And you are also keeping your stop loss below the low of the rejection candle. Okay, so which means whenever the price opened here, there is a fight between buyers and sellers, right? So this wick, buying wick created by the strong buyers at PP. So whenever you keep a stop loss below this level, there is a high possibility of price going on the upside. Now the entry part is over. Now the most important part, exit point. See, many traders get a lot of confusion with exit, because any exit will bring some emotions into your mind, right? Because nobody can exit at a day's high, right? Nobody. Only God or maybe some liars can exit at the top. But most of the people, 99.9999% of the people, they will not be able to exit at the day high, right? So it's very difficult. So for such type of people, what you can do is, if you are really a conservative trader, very very conservative trader, then you can exit 50% of the position at R1, and whenever price crosses above this level, you can trial your stop loss to your entry price level. So in this way, if the price consolidates, even if comes back here, you would have made profit for 50% of the position, and remaining 50% of the position, no loss, no loss, right? So otherwise you are okay to take little risk. Okay, so if you are okay to take little risk, then what you can do is, this is R1, then what you can do is, let's say you take an entry, so this is your long trade, this is your stop loss. So in that way, whenever the price goes like this and crosses R1, you can trial your stop loss to the entry point. So this is your entry point, you trial your stop loss to your entry point for all the position, 100% of the position, and whenever the price reaches R2, you can exit 75%, because most of the cases or most of the trading days, price will not go above R2 on majority of the cases. So you can exit 75% or even 100% of the position at R2, and whenever you exit here, the remaining position, for the remaining 25% of the position, you can keep, or you can push your stop loss from here, it will be here, right, to just below R1. So in this way, even if the price comes back and hits your stop loss, you would have exited 75% of the position at R2. It's a very good price level, and remaining 25% you made little profit, right? And in another case, suppose let's say price went upside from here, but still you would have made profit, good profit for 75% of the position, and you would have made some extra profit for this remaining 25% position as well, right? Because you're carrying this, right? Okay, so you can exit at days high, or maybe you can trial your stop loss to below R2 and you can exit. That's how you can manage. But I'm telling you very openly, very honestly, nobody can exit at the day high. Even I can't exit at the day high. Nobody can exit at the day high. That's very, very clear. You need to define some exit rules, exit strategies, which triggers less emotions in your mind. That is the basic idea. That is the basic rule you need to follow. So after the exit, let's say you have made some rules, exit rules, by backstudying with couple of things. Once you exit, definitely on many trading days, price would have will move in the expected direction. So you might think I would have made extra profit if you would have holded the trade. So as I said earlier, nobody can exit at the top. You need to remember that point very, very well. If you made some profit, it is fine. Be happy, be content, and there will be next day, right? Because market will not go anywhere. Market will be there forever. You need to look for the next day, right? So that's how you can use PP, R1, R2. Similarly, you can use S1 and S2. I will show it in a while. I'll remove this. Tada, 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 tada. So similarly, you can use for here PP. I will take a different color. Okay. So let's assume this is your PP. I will little bit highlight it. Okay. So this is PP. I will change the color now. No, this one. Okay. So now let's say this is your S1 and this is your S2. Okay. So let's assume the previous day trend is negative or the overall trend is negative. The price opens just below the PP and price displayed a resistance below the PP. So it's ulta, same thing. So your short trade entry will come below this candle. Again, this is a 50-minute chart and you can keep a stop loss above this level. Okay. So whenever this happens, very conservative traders, they can exit 50% of the position at S1 and carry remaining 50% of the position, keeping stop loss at this level. Or if you are okay, I would suggest at least for short trades, you can hold it because the fall will happen very quickly. Okay. So target S2. Okay. You can exit 50% of the position at S2. So whenever you make the exit, you will push your, TSL to little above S1. So and keep and hold for the rest of the day. So in this case, even if the price, if it goes down, it's well and good because you would have made good profit for this remaining 50% of the position. But if the price comes back and hits your stop loss also, it's okay because you have made good profits with 50% of the position and you would have made some profit for this 50% of the position as well, right? So that's what, you can't carry 100% of the position at day's low. Nobody can do that. It's not possible. Okay. So that's practically impossible. It can happen maybe on one day out of 1,000 days for one person, but not for everyone, not on all the trading days. So with this exit strategy, you will be content and it triggers less emotions on many, many trading days. So this is how you can use PP, R1, R2, S1 and S2. Now we'll go a little bit forward. Price action at R1 and S1 is very, very important. I will explain this first, then I will go to charts and I will explain few things. Okay. Now, uh, uh, let's say this is PP and this kind of question will only appears for some people who spend some time in intraday. Okay. So this is R1. Now this candle displayed, or for some reason, let's assume somebody have taken a trade here. Okay. So they have taken a long trade here. They have kept a stop loss here. Now they don't want to, this is an advanced level concept. Friends, if you are a beginner or even intermediate level trader, it's okay. You don't have to try to understand this, but if you understand this, it's well and good, but don't try to implement it on the first day or on the next day if you're a beginner. Okay. So now let's say the price went till R1, exactly touched R1. After spending some time in the market, especially intraday trading, people will get confused whether to exit at R1 or to hold the trade. Okay. So again, there are two concepts here. You can check the candlestick patterns. Okay. If you get bearish engulfing, so bearish engulfing look like this. This is a bullish candle. This is a bearish candle. Okay. I will write down using the proper colors. Okay. So you will get a complete clarity. So bullish engulfing look like this. For example, this is the first candle is a green candle, not bullish engulfing, bearish engulfing. I'm really sorry. And the second candle will be red color. See, it appears like this. It's a big red color candle. Okay, so this is bearish engulfing. So whenever you get a bearish engulfing candle, this is a very, very powerful pattern. And whenever you get this pattern, you can exit the trade or exit 50% or 75%, or at least what you have to do is keep or trial your stop loss to below the low of this bearish engulfing. Okay, so this is one you have to do. So another strong bearish candle is bearish Marubozu. For example, it looks like this. It is a big red candle. Okay, I don't want to fill this anyway. I'll fill it. So it looks like this. Okay, so without any wicks on the downside or upside, a small wick is acceptable on the upside. So whenever you get this here, you can exit 50% or 75% of the position, or at least you have to trial your stop loss below the low of this. Okay, this is one simple way to manage your trades. But there are some people who want to rely on the price action instead of the candlestick pattern, because on many trading days you may not get the exact bearish engulfing, you may not get the exact bearish Marubozu, right? So on that cases you need to look for the price action, which is called as price acceptance or price rejection at important level. Now, as you know, R1 is very, very important for today. So if the price starts spending more time here, so which means shorts are getting built. Okay, sellers are there, they are selling it, but their power is not sufficient enough to push the price on the downside, right? Which means it is spending time here only, which means this price level is getting accepted, and there is a high possibility. Remember very carefully, there is a high possibility, not 100% certainty, because anything can happen in the live market. So there is a high possibility of price going on the upside. Now, whenever you spot this pattern on the chart, you can hold the trade with maybe entry point as your stop loss, or maybe with original stop loss, right? Whenever it displays a price acceptance just below R1. I will show it in the charts in a while. Okay, don't worry. So this is price acceptance. So this is called as price acceptance, which means this price level is getting accepted. So the price is, there is a high possibility of price moving in the same direction. Okay, this is price acceptance. Now another one, price rejection. So what happens is the price comes here, it immediately tries to break the R1, but immediately in the same candle it comes back, maximum next candle it comes back, it starts trading below R1. So this is called as price rejection. Okay, in candlestick perspective it looks like this. Assume if this is a candle, this is a candle, the wick look like this. Okay, in this case price tried to break above R1, but it failed. It immediately closed below R1 in one candle itself, or maybe second candle, not more than two candles. So on 15-minute chart I'm saying, and this is only for intraday trading. So this is called as price rejection, and whenever you see this, it is better to exit the trade, because whenever you see a price rejection, I will show it on the charts in a while. Whenever you see a price rejection, so price may not go down immediately, but there is a high possibility of price getting into sideways. It will not go immediately, that is for sure. For intraday traders, time is very important, friends. Time is our money, right? Especially if you are option buyer, time, if you hold your trade for more time, means your premium is gone. So time is money, money, money. So whenever you see price rejection on the chart, it is better to exit the trade. Price acceptance, hold the trade. Price rejection, exit the trade. I will show it on the charts. For example, I will come here, I will go to here. Now I will mark only R1 and R2. Okay, see, this is still forming, it is fine, but see here, if you would have taken a trade, assume you would have taken a trade here. See here at S2, this is not rejection, right? This is it's accepting. Okay, it trade closed below this. Okay, it means it rejection even S2, so that's why it went downside. So today it might be confused, that's fine. But if you go back little backside, I will go little backside. Okay, see here, the second candle itself, this is a price rejection, right? So price rejection means it may not go down. As I said earlier, it may not go down immediately, but it will get into sideways mode. It will not go up immediately for sure. That's what I said, right? See here, price get into sideways mode for how many candles? Close to 4 5 hours it went into sideways mode, and then it gone up that to little bit chota mota, right? So no use. See here, the price broke this level, decisive close, right? And this accepted, right? This price acceptance, it is didn't bounce back, right? This is price acceptance. See, it went into downside. I will clear this. I will go a little bit backside so that you will get understand. See here, this is price rejection, right? Price try to break on the upside, and the next candle itself is closed below the downside. This is price rejection. Do you agree? Okay. See here, price went above a PP. This is price acceptance. Okay, but unfortunately, it didn't move on that particular day. That is fine. That's okay. Okay, no problem. Now I will go a little bit this way. I'll clear everything so that see here, this is price rejection, right? Price rejection at PP. Here also one more rejection. See here, it went downside, right? See here, this is not proper rejection. Okay, it closed little above this, but it should show strong rejection. At least it should break the 50% of this candle, right? So that still it continued. I'm looking for price acceptance example. I'm not getting it. I will clear this for example time being. See here, there is an example of price acceptance. See here, assume you would have taken a trade here. Assume you would have taken a trade here. This is your entry, long trade. This is your stop loss. Now price reached perfect setup. Price reached R1. Now you are confused whether to exit or not. See, in R1, it didn't break R1 and closed below this, right? No strong rejection. These two small candles. So these small two candles represent price exception, right? That's what I said. See, you carried and it went upside, right? Okay, this is a proper explanation or perfect setup I explained. So you can also see, one second. See, you can also see here, right? This is I think this is R1 or R2. It acted as a rejection, right? Immediate rejection, right? So you should remember, if you get the clarity about price acceptance and price rejection, your trading changes like anything. See here, in this case, price tried to break the R1. This is R1. Price tried to break the R1, but see here, this is a strong rejection, right? So what I said is, it may not go down immediately, but it will not go up for sure, higher probability, right? See, for rest of the day it went into sideways mode. See here, perfect rejection, right? Okay, see here, price acceptance, right? It didn't rejection, it didn't go down, right? It didn't tested above this and came back, right? This is a price acceptance. I can go on and on and on and on, but I'll go for the next few days and then I will wind up. Okay, I think that's all. It's not coming here. We can extend this, but I don't want to extend this. I want to cover a few more important points here as well. Now, there are different types of pivot point, friends. There are standard, Fibonacci, Camarilla, OD. So I've not explored all these things. I've explored Fibonacci pivot points, but the PP calculation in standard and Fibonacci both are same. High plus low plus close divided by 3 is in standard, it's in Fibonacci. But only for R1, R2, S1 and S2 calculation, Fibonacci, they use Fibonacci numbers. In standard, they use the formula. Okay, it's almost the same. So I suggest you can use either standard or Fibonacci. Do you want me to make a separate video about how to use only Fibonacci indicator? If yes, please leave in a comment box. I will think about it. Okay, because I also use Fibonacci, especially for my long-term trading and investments. Okay. Now, whenever the price opens above R2 and R below S2, because as I said earlier, these levels are very, very important. For example, if this is PP, if this is PP, if this is R1 and this is R2, this is R1 and this is R2. If the price opens above this R2, it means price is showing a huge gap up open, okay, compared to the previous day range. So whenever the price opens above R2, it's very difficult because long-term sellers will also enter the game, and there will be a big fight between the buyers on this particular day and the strong sellers from another time frame. So I suggest you should not get into the situation where the big buyers, big sellers are fighting with each other. No, don't get into the situation. You will be trashed. So it is better to stay aside and watch their game. Whenever whoever wins the game, you can join them little bit later. Okay, you might make little less profit, but it is fine. You will make profit. You don't lose money, right? So whenever price opens above R2 or below S2, I suggest to avoid trading on that particular day. Now, SuperTrend. Some people, who have difficulty to uh, use price action with PP, they can also use SuperTrend indicator. For example, it works like this. Let's say I have plotted. This is PP, right? So I can also plot SuperTrend indicator. It defines the trend. It's very simple. Okay, there is no magic in it. Okay, see, it defines a trend. So whenever it defines a trend, you can look for a short trade whenever the price breaks or opens and accepts below the PP. See, for example, here the super trend is bullish, but price is below PP, right? So, and it showed rejection here. So we don't take a long trade. See here, the super trend is already bearish from the previous day. Price took resistance at this PP. So you can look for a short trade below this level, right? See here, the price, oscillated above and below PP. You can avoid it. Okay, it's always a bit risky. See here, price, super trend is bullish. The price opened, opened below PP, but it stayed above PP. If it had taken a long trade, maybe it is a break-even trade, or maybe you didn't made profit, small loss. It is fine. It's acceptable. See here, it exactly took a resistance. Super trend is already bearish. You can initiate a short trade, right? Because the trend is already bearish. Here, it is above PP, super trend is bearish, so it is giving contradictory signal, so you can avoid the trade. Maybe that's why you didn't lose money, right? Even if you would have taken a short trade, it wouldn't have given much profits, right? See here, super trend is bullish, price opened above PP. You could have, it showed rejection at this level. So if you have taken a trade, profit, right? See here, price is already, super trend is already bullish. Price took exactly support at PP. You can take a long trade above this level, keeping stop loss below this level. You can exit at R2, right? Same here, the same here. So in this way, you can use super trend indicator to get the trend. Some people, they have tough time to identify the trend. So only for such people, especially for beginners, they can use super trend. Super trend just defines the trend. That's all, friends. I hope that is the end of this presentation, friends. Do you want me to cover any other important aspects in trading? If yes, please leave a comment. If you think this detailed explanation about PP is really helpful, then you can leave a comment. You can like the video. You can share this video with your friends who are having tough time to learn trading, and you can also look for membership on my YouTube channel, because I also offer membership on my YouTube channel, and I make a dedicated specialized videos more than this, okay, for members, because I also share my practical experience from trading. So if you want to elevate your trading level, you can also become a member for my YouTube channel. I think that's all, friends. We will see you with another video with another useful content, with jam packed content like this. Until then, thank you. See you. Bye bye. Have a nice day.